Hi, morning everyone. Welcome to our morning webinar on Monday. All right, this is Colin, the telecoms and technology analyst, and this will be my first foray into the healthcare sector. So today I'll be giving a presentation, a short one on Raffles Medical Group, which is a leading healthcare integrated healthcare organization in Singapore. Right, so this is a brief snapshot on the company. Share price was last traded Friday at $3.81, right? And the market capitalization of the Raffles Medical Group was at around 2.2 billion in Sing dollar term. And right, based on our estimates, the share price is roughly trading at about forward P based on FY15 earnings of about 30 times, right? So in the following slides, I'll just share briefly more on the overview of the company as well as the financials, right? So on to the company is Raffles Medical Group, was first listed since 1997, right? And it mainly operates medical clinics under the brand of Raffles Medical, located island-wide in Singapore, and it also operates a tertiary care hospital, its flagship building, Raffles Hospital. It also boasts insurance services arm and also a consumer healthcare division, right? The group was first founded in 1976 with only just 2 clinics, which were located at Cecil Street and Maxwell House. And since then, over the years, it has expanded to over 70 medical clinics across Singapore, and it also has 4 medical centers in Hong Kong and Shanghai. This also includes the airport clinics, which in Changi Airport, as well as Hong Kong's Chang Lap Kok Airport, right? Since under one of the co-founder, Dr. Lu Chun Yong, who is still the executive chairman of Raffles Medical Group, right? So apart from him, the group also boasts a very experienced management team and clinical leaders to lead the various business units, right? Raffles Medical Group is also a beneficiary of aging demographics, rising medical tourism, and growing affluence in the region, and hence it has seen its revenues being growing at the top line over the years at roughly about 13%, which I'll share in the following slide, right? And on its patients base, right, a huge number of patients is actually was accounted by foreigners from over 100 countries, right? Management has shared that roughly about 1/3 of its patient base are in fact foreign based, while the remaining 2/3 are mainly coming from the local resident population, right? Also, some things noteworthy is 2 key developments, which is first, the extension of the existing Raffles Hospital, which will see the floor space of Raffles Hospital being expanded very significantly, which I'll share more in the following slide. And also the other development is the new retail mall in Holland Village, which will also house some of the Raffles Medical Clinics, specialist clinics, and also it will help boost some rental income to the group as well, right? So this is just a graph on the historical revenue growth since its listing in 1997. The top line growth has grown very strongly at roughly about a 13% CAGR over the years, right? So just a brief overview on its business segments. It mainly reports its operation in mainly 3 segments, which are namely the healthcare services, hospital services, and the investment holdings, right? On the healthcare services, right, this mainly accounts for the medical clinic operations, health insurance, as well as sale of pharmaceutical products and consultancy services, right? The healthcare services accounts for 34% of revenue and about 15% of operating profits, right? And over the recent years, it has a stable operating margin of roughly about 9 to 10%, right? On the next one, the hospital services segment, this is in the biggest earnings contribution as well as the top line, right? it mainly accounts with its specialized medical services, hospital operations, medical laboratory, and imaging centers in the Raffles Hospital, right? It accounts for a big bulk of the revenue, about 63%, based on the last fiscal year results, and operating profits accounts mainly about 70%. This is mainly due to its much bigger margin at 25% operating margin as relative to its healthcare services. Right, and also Raffles Medical Group also owns the shop units within the hospital itself, as well as commercial units within Samsung Hub, which are leased to external customers. So Raffles Medical Group mainly earns from some of the rental income, which over the space that were leased out to the external customers, and mainly this business segment accounts for 15% of its operating profits. Right. So more on the overview of the healthcare sector. Key growth drivers for the healthcare, which will lead to the rise in healthcare demand, is firstly on medical tourism. Right, we have seen the expenditure by medical tourists grew at about 16% CAGR since from 2004 to 2013 over the 10 years period. Right, so we see that Raffles Medical Group will benefit from the rising medical tourism, with higher patients being attracted from all over the world to Singapore. Right. However, in recently, do note that expenditure was slightly down in 2013, and which was mainly attributed due to the falling Indonesian rupiah, as Indonesian make up for a large bulk of the foreign patients in Singapore. Right. However, we do foresee that this will recover as the Indonesian rupiah stabilize, and also under a new presidency, Indonesia will is still on the track to growth, and we do expect this will lead to a recovery in the medical tourism in Singapore. Right. And what some of the attributing factors for this growth is firstly that Singapore is actively attracting patients from neighboring countries, not just on the private healthcare organization, but also from the Singapore Tourism Board as well. Right. Also, over in other foreign neighboring countries, demand has also outpaced the supply. Healthcare demand outpaced the supply, so that has led to some of the foreigners, especially in the affluent class, to seek medical treatments overseas. Right. And thirdly, given Singapore's excellent reputation as a healthcare hub in the region, right? So this has also lured and attracted many foreign patients to seek medical services here, given its quality reputation over its healthcare standards, right? Also, with the rising affluence in Singapore and as well as in the region, right, this will likely boost private healthcare spending as the consumers' ability to pay for private healthcare spending is improved, right? So this will definitely lead to a boost in the healthcare spending, right? Consumption expenditure on healthcare services has in fact grew about 8% over the last 10 years from 2004, right? If you look at the chart on the right, mainly you see that the GDP per capita in Singapore and its neighboring countries have improved over the last 5 years. Right? And also medical expenditure by tourists, though it's volatile, and has been impacted by some of the major events, which includes Asian financial crisis, SARS, and the global financial crisis in 2008, right? But over the long term period, the medical expenditure by tourists is still on the uptrend, right? And this and the next is mainly one of the key growth drivers for the rise in healthcare demand is the aging demographics, which Singapore currently faces, and also is a common problem that's faced by other developed nations across the globe, right? In fact, now residents that are aged 65 years and above are now accounted for 11.2% of Singapore's resident population, which was reported as of mid-2014, and this was up from 7.2% in 2000. So we do see that as the old age support ratio declines, right? We expect demand for healthcare services rise as the elderly tends to have more healthcare conditions, right? Also, rising life expectancies in Singapore will also lead to a rising demand as people are living longer, right? And also, in the public healthcare hospital sector, they are also facing a hospital bed crunch. So this has also led to some of the demand to spill over to the private hospital segment, right? In fact, so if we look at this chart, this shows the bed occupancy rate that are faced by the public hospitals. So over the last few days, occupancy rates have generally been trending above the 80 to 85% level, which is considered high. So hence, they're also facing a bed crunch. For Raffles Medical Group, although they do not disclose the bed occupancy rate, but management has shared that the current bed occupancy rate is well below the national average that's faced by the public hospitals, right? The ideal occupancy rate, this was shared by one of the spokesmen at Parkway Holdings, that the ideal rate should be between 70 to 80%, right, over the ideal utilization of beds in the hospitals. Right. Okay. So for now, I will just share more on the key developments of Raffles Medical Group. First one is the extension to Raffles Hospital. The group has acquired a land site that's adjacent to the Raffles Hospital for 105 million in beginning of this year. They have also obtained approval from URA to increase the plot ratio of the existing hospital from 4.2 to 5.6. So this will help to yield additional floor area of 100,000 square feet. So combining the total combined space expansion, right, this will imply a 72% in a potential increase in Raffles Hospital gross floor area, right? Rationale for this is the group seeks to expand this range of specialist centers, clinical research activities, and also the staff training grounds for its healthcare professionals. Also, it will help to free up existing hospital space for more beds, as once the specialist centers in the current Raffles Hospital is moved to the new extension, right, this will help to free up the space that's currently existingly used by these specialist centers for more hospital beds. And the project is estimated to be completed in 2017, right? So with the expansion, this will likely lead to a further revenue growth over its hospital services segment. And also, and as they expanded their capacity to accommodate more operations and more patients as well, right? On the second key development is this Raffles Medical at Holland Village. The group has also acquired a property in also around the same time, in the beginning of this year. They have acquired the property at Holland Village, specifically is 100 Taman Wana, the location site, for 55 million. Right, and they are planning to redevelop this property site into a 5-story mall with 62,000 square feet floor space, whereby 72% of this floor space is a net leasable area. Right. The rationale for this acquisition is, first, the property site is located near Holland Village MRT station, so this is ideal as it allows easy accessibilities for patients seeking treatments at Raffles Medical Clinic, right? Raffles, the new property site will also accommodate the Raffles' own medical clinic as well as specialist clinics to cater to both locals and expatriates living in Holland Village and the nearby areas, right? And the remaining available space will then be leased out to banks, retails, and F&B outlets. So this will also help to boost some retail rental income for the group, right? And the project is expected to complete in 2016, right? So these two key developments is a great potential growth over its revenue in the future, right? And it doesn't just stop there, right? Raffles Medical Group, although they are still enjoying growth in the Singapore market, right, the group also intends to expand in China and Hong Kong, as they intend to build 2 tertiary hospitals, one in Shenzhen and another in Shanghai, right? They have actually signed a letter of 10 and has also entered into a framework agreement with the respected groups in China to mainly build the tertiary care hospitals of about roughly 200 to over 300 beds, right? Whereby the bigger one it will be in Shanghai, where this will be a private hospital of over 300 beds, right? And it's located in Shanghai's business district. Right. So some of the key upsides for these projects is that the China government is encouraging foreign investment in the joint venture hospitals in China. So hence some of the healthcare organizations are also seeking to expand in China region, right? And also likewise, China is also is facing a situation whereby healthcare demand is outstrip the supply, right? As well as aging demographics and overcrowded hospitals. So this will definitely has some potential boost to the private healthcare sector in China, right? However, the risk of that is that it may come from a tight supply of healthcare professionals as well as tight regulation on foreign staff employment in the private healthcare sector. So hence, this may pose some potential risk over the expansion in China, as Raffles Medical may not be able to get the sufficient manpower to operate its hospital should this expansion be realized, right? However, details are still very sparse and no concrete details have been announced ever since the last announcement with regards to the group signing the letter of intent and also entering the framework agreement. Right. So on to the financials. The figure on the top left mainly show the revenue contributions from these three business segments, which I've shared earlier, whereby hospital services is the main contributor to its top line. Right. Revenue growth has in recent years has been trading over the 9% to a low double-digit range. Right. And we do foresee that this will continue to the growth is mainly sustainable in view of the rising healthcare demand as well as the business expansion, right? And the two charts over the bottom row mainly shows the growth in the healthcare services and the hospital services respectively, right? Hospital services, the growth has actually been tempered mainly due to the decline in Indonesian patients. However, the management has shared the overall number of foreign patients is still on the rise, whereby they're still seeing more patients coming mainly from the Indo-China, as also patients even from Russia as well, right? They do expect that once the Indonesian rupiah to stabilize, there will be a reversal of trend in the number of Indonesian patients, right? Healthcare services has also been growing strongly. In fact, in recent quarters, the growth in healthcare services has in fact picked up, which was boosted by the growth in its healthcare insurance business, as also Raffles Medical Group has two major corporate client accounts, right? More on the margins and expenses, right? If you look at the contribution over his expenses, staff cost is the biggest item in its expense line, whereby staff cost accounts for 63% of its expense item. So despite Raffles Medical Group facing a rising staff cost, however, they are able to hedge this as the rising staff cost would be passed on to the patients and customers through higher hospital bills. In fact, currently, Raffles Hospital, the bills is still at a discount of over 20% as compared to the more reputable hospitals in Singapore, which are namely Gleneagles and Mount Elizabeth. Right, so we do think that there's still further upside for the hospital bills without tempering too much on the patient's demand, right? On the operating margins, operating margin has been stable at roughly 20 to 1% over the last few years, right? And earnings growth has in fact been very impressive, right? Has always been growing at roughly two digits range, right? However, because Raffles Medical Group has a scrip dividend policy, whereby some of the dividends are actually being distributed as shares. So hence that has led to some dilution on the earnings per shares, and led to a slight depression on the earnings per shares, right? But however, otherwise it's still growing at a very healthy rate, right, of a high single digit to a low double digit range, right? On its net cash positions, right? In the last year, Raffles Medical Group has actually sold off Tong Xia Building, which they used to have a stake in it. So that has led to the high net cash position. And given its current net cash position of 261 million in the last fiscal year, this is enough to internally finance its two key developments, in addition to its future cash flow streams, right? So this will allow Raffles Medical not to take on any excessive borrowings to finance these key developments, right? The Raffles Medical Group also enjoys a very steady stream of cash flows, right? And we are expecting, based on the overview of the healthcare demand, right, growth forecast in revenue will mainly be sustainable at roughly about 9 to 10%, right? And however, on the earnings, do take note that FY17, the earnings will likely be lower, as this will be weighed down by higher depreciation expense once the Raffles Hospital extension and the new mall at Holland Village are completed. Right, so just a quick summary on the key investment merits and risks of Raffles Medical Group. Key merits are mainly is the group's competitive strength, and also do note that Raffles Medical Group subscribe to a group practice model. This is mainly a model whereby the specialists and doctors are in fact on Raffles Medical payroll, whereby other private healthcare operators, the specialists and doctors are in fact its own independent practices. So hence they mainly they are not on the private healthcare organization. They are in fact on their own, right? But however, under the group practice models, in fact, every of Raffles specialists and doctors are under the group's payroll, and this has allowed the group to offer integrated team-based healthcare for its patients, as patient information are easily shared through a common database under Raffles Medical Group, right? Rising healthcare demand in Singapore, mainly due to aging demographics, medical tourism, and rising affluence. The region will also help to boost the growth in Raffles Medical Group. And also other merits will include its defensive business and strong cash flow generation, as healthcare is a necessity rather than a luxury among the resident population, as well as the foreign patients that coming here to seek treatment in Singapore. And also that the group has a very strong growth potential with business expansion plans in China, right? Some of the key investment risks will include the expansion of capacity and quality improvement in the public healthcare segment, as right now the government is intend to significantly expand the capacity as well as the quality improvement, also by building more hospitals. So if they are able to resolve some of the tight bed crunch that's faced by the public hospitals, we do see that some of the demand might spill over to the public healthcare sector. So that is one risk that Raffles Medical Group actually faces, right? It also faces rising staff costs, which is the biggest item under its expense line. However, as I've shared earlier, Raffles Medical Group is able to pass the cost to its consumers and patients. So hence, this risk is not very worrying, right? And it's not much of a concern, right? Also, should there be a potential Ebola outbreak that happens in Singapore, or any crisis that's quite similar to SARS, right? This will definitely has an impact on the medical tourism, right? And as Raffles Medical Group, one third of its patients are mainly foreign based, right? This will definitely lead to decline on the foreign patients in such an event, right? However, this risk is still mitigated due to the other 2/3 of its patients, which are still locally based, right? And of course, Raffles Medical Group is not shielded from regulatory risk on the healthcare industry. This is as is very tightly regulated by the authorities, and also execution risk in the 2 development projects. Right. So just come to the last slide of this presentation. Right, despite the positive growth potential of Raffles Medical Group, right, in our view, share price is currently trading at very high, pretty high valuation at about for PE of 30 times, right? So in view of the valuation at the current share price, we are giving a neutral recommendation, right? Though that some of the positive price catalysts that might push the share price up further will include the concrete plans announcement of expansion in China, as well as a strong recovery to Singapore's medical tourism, which was recently impacted by the strong Singapore dollar and the falling Indonesian rupiah. Right, we value this the group at $3.90 per share based on our DCF valuation. Right. So for more details, you can refer to our initiation report that was dated the 1st October. Right. This report is uploaded on Poems. Right. So you can log on to Poems to check the report for further details. Right. So we just come. So we just conclude our presentation. Right. So if you have any questions relating to Raffles Medical Group or any other questions, to ask. Right. Right. There's a question on whether Raffles Medical Group has any sort of talent retention programs since they're on the group sharing models. Right. I think this healthcare industry is actually very competitive, whereby some of the quality doctors are actually being highly valued by other healthcare organizations. So how does Raffles Medical Group mainly retains its quality staff is mainly first through competitive pay packages, right? Which is definitely in line with other that might be offered by some other private healthcare practices. And also the second is mainly share options, right? Whereby all of Raffles Medical Group staff are also entitled to the share options. So this will help to help the group to retain some of its more capable quality healthcare professionals. Right? Right. There's a question on how Raffles Medical Group is being compared to Relegate Health Trust in terms of investment value. Well, I think the main thing to note is that Raffles Medical Group is mainly still enjoying growth in mainly Singapore market, right? However, Relegate Health Trust, these operations are mainly India, so that is mainly a different geographic locations, and they are investing mainly in the hospitals and medical establishments over India, right? So mainly is in terms of the investment value. However, Raffles Relegate Health Trust is currently not under our coverage, so we are unable to give a recommendation or in fact in our view on the valuation, right, of it. But however, we do see that Relegate Health Trust also has a very strong growth potential, mainly due to the rising healthcare demand in India as well, right? As they are also ramping up on the private healthcare sector, right, over in that country. Right. Comparing Raffles Medical versus IHH, right? IHH is still the biggest healthcare operator in Singapore, as they operate the mainly the clinicals and the Mount E hospitals, right? However, the practice are slightly different, right? As I've shared that specialists in the IHH are actually independent operators, so hence they actually earn their own pay, right, from the operations that they conduct, right. They are mainly using the hospital grounds or rather borrowing the hospital facilities to do their own surgeries, right. So hence the health IHH mainly earns from there, right. So so in view of investment value, in our view, IHH is also trading quite a pretty high valuation, right? And also both are still enjoying growth. IHH is also looking to expand in China as well, right? To seek further growth potential, right? So relative wise, I think both are considered at pretty high valuations, right?
Hi, Joshua here, the head of research. Just to readdress the question on the difference between Religare and Raffles. Also, we note that we're taking a preliminary look at Religare, and we find that it has very strong growth potential. Basically, its average revenue per operating bed is on an uptrend. It's only installed 2/3 of its bed capacity. That means it's got a lot of uninstalled bed capacity, which can actually increase by about 50%. Current utilization of the beds, of the operating beds, are about high 70s, which is basically the range that you want it to be at for a hospital, because you have to always give room for spikes in usage. For example, if there's a disease breakout and you need the extra beds. And I think one of the other good things that Religare has for it is that the macro environment for India is improving. So previously, where you might give it a macro discount based on the rupee, right now the rupee is on an appreciating trend. Reversing its depreciating trend. In our recent visits to India, we also note that a lot of the country has rallied behind Mr. Modi, and we think that in India, we have never seen the country more united than ever before, and I think that is a positive as well. We'll give you more updates on Religare in the future. Thanks.
Question on how often does Raffles Medical Group actually gives out dividend, and the current dividend per unit mainly actually is giving out shares, whereby right now, based on the current share price, the dividend yield is roughly is less than 2%, roughly about 5 cents cash dividends. However, they also give out stock dividends as well annually. Right. So in fact, so if you're actually holding on to Raffles Medical shares, you are also applicable to subscribe to the stock dividends as well. Right. However, based on the current share price, right, dividend yield is not very attractive, as the yield is only about it's only less than 2%. Right. In fact, it's towards the lower 1% region. Right. Right. who are the major shareholders and funds of Raffles Medical Group, right? Mainly the major shareholders, and in fact, majority of the group is actually owned by Dr. Lu, who is one of the co-founder of Raffles Medical Group, and he has been actively been in the management as the executive chairman of Raffles Medical Group, right? So public float is mainly roughly about 40%, right?
Hi, Benjamin. I have a question on Keppel Corp. Question is how the earnings were affected due to the steep drop in crude oil prices. So currently, the immediate effect of the drop in oil prices will not have an impact on their earnings for the next 1 to 2 years, right? Meaning up to FY15. But the worry that of Keppel Corp's earnings is going forward in the medium term wise, when the order book cannot be replenished on a yearly basis, where they can't win more orders for rig building due to a slowdown in drilling activity because of the lower oil prices. That's when the earnings will be impacted. Right, so currently our view of Keppel as well as Sembcorp going to FY15, the large impact is usually largely coming from less order wins compared to this year. Right. Benjamin back here again. I have a question on any signs of impact to order book in Keppel and Sembcorp. Currently, no, we have not seen that. But one thing to note is that over the course of the last 1 month plus or so, we have only seen one win of jackup from both Sembcorp and Keppel, which is from Japan Drilling. Right, going forward till the end of this year, we do not expect them to win any orders in terms of floaters, which is your semi-subs and your drill ships. But one key thing to note going forward, right, is that currently what we're seeing from a lot of the asset operators in US, right, a lot of the rigs are either going idle or any rigs that have been recontracted, they're taking about 30-40% discount to day rates. So on the demand side, we are already seeing a slowdown. Right, so this going forward will mean that the demand for more ordering activity will be slowing down. Right, so we'll continue to monitor this situation for the next half a year or so. Right.
Hi, we have a question on Ezion. Our coverage on Ezion is currently under review due to change of analysts. But so far as we see it, it's the segment that they're in, which is mainly servicing of existing production, should be better relatively shielded than oil and gas players in the capital investment side of things, right? Because if installed production should continue to go on, and at $80 a barrel, most offshore is still profitable, or even if it's less profitable than what it was before. So on that note, we're not too bearish on companies which are in this side of the value chain, which is production, and that is kind of where Ezion is in. And also Ezion using self-elevating units is a piece of equipment that is enjoying increasing usage.
Hi, morning. This is Richard speaking, transport analyst. There's a question whether there's a change in the last SMRT recommendation. No, there's no change. If you look at the cash flow statement for the SMRT latest results for 6 months, half year, actually the operating cash flow is currently not able to sustain their capex, and if you want to draw a comparison, you can compare with what has been happening to SBS Transit in the last 3 to 4 years, when their operating cash flow was not able to support the capex. Dividend had been cut, and share price also tapered downwards accordingly as well. So actually this quarter, when they actually increased the dividend from last year, is actually really dangerous, because there's actually no cash flow and is based on their accounting profits. Thanks.
A question on the interest rate cut in China. Generally a positive thing, as you can tell that global growth has slowed somewhat. Perhaps only the US having very positive data, while the rest of the world is having very flat to mediocre data. So I think this rate cut is a timely boost to improve that outlook. Where do we see the STI in 12 months' time? Well, we still see it as a bull market. I don't think that's over yet. Also, although macro data has not been very good in the past month, we do note that such a substantial drop in the price of oil is going to result in a massive economic stimulus that will be global. Any comments on where the S&P 500 year end will be at perhaps 2100? Someone is asking. I think we are very neutral on the US right now, because it has run a lot, and short-term technicals continuously overstretched. And I think it would be better to be more bullish on more underperforming markets. I think China A shares, H shares, Singapore, Indonesia, Thailand, these have all been underperforming markets. Okay, we thank you all for attending today's session, and we very much look forward to having you all again next week. Have a good week ahead. Thank you.